Hello, and welcome to the CFA Society San Francisco podcast, where we interview and discuss trends with leaders from across the investment and finance industry. This month, our host Tanya Suba-Tang, Membership Director with CFA Society San Francisco, had the pleasure of speaking with Heidi Ridley, CFA, co-founder and CEO of Radiant Global Investors. Listen in as they discuss ESG 3.0 and its application to small cap investing. Hi, Heidi. It's great to see you again. How are you?
I'm doing so well. Thank you so much. It's great to see you as well.
I'm very excited to have our conversation. And for our listeners, Heidi Ridley is the co-founder and CEO for Radiant Global Investors. And I love this because your firm focuses on small cap active equities and investment that have positive social and environmental impact. And we're going to have a lot to talk about today.
Absolutely. It's a very interesting space and evolving daily as we speak. So thanks for the opportunity to talk a little bit about it, especially during Earth Month.
Yes. So getting right on with our conversation, when we talked about doing this podcast, you had mentioned the need for an evolutionary step in ESG. So let's start with what you mean by that.
Sure. I mean, as we see it, we're on the cusp of an evolution in our collective thinking on ESG, or more broadly, sustainable investing. The first wave of ESG investing, which should more correctly be referred to as SRI, or values-based, focused on religious or political exclusions and socially responsible choices, has origins dating back 50 years or more. Fast forward to the 90s, there was a flourishing of ESG investing that was environmentally focused, which avoided polluters. And in the next wave, let's call it ESG 2.0, we saw ESG concepts enter risk management logic as practitioners began to wake up to the fact that companies that were not using their resources wisely, whether those resources were physical, human, brand, what we would now call license to operate, represented greater risk. And investors also started exploring the other side of the coin, which had to do with preferencing companies that looked attractive along those same dimensions. And we don't disagree with any of that logic, but there has been an obsession with scores and checking the box on 100 different KPIs and lowering a carbon footprint versus a broad market benchmark, but to what end? And I think it's time to acknowledge that exclusions, acronyms, and scores, while compelling and catchy, don't serve us well in an investment context, given the natural complexity and constantly shifting landscape of capital markets. It's paramount that we move past ESG ratings to instead focus more directly on how a company interacts with its ecosystem and what the resulting implications might be as part of mainstream investing. So said differently, rather than abandon ESG considerations as one side of the political cohort is advocating, or increase the number of KPIs and checkboxes as supposed demonstration of more thorough analysis, as some in the investment community seem to want, we should instead be getting more sophisticated evaluations of companies, meditating on what it will take for a company to truly thrive in a changing landscape and be a source of value creation for all stakeholders as we move forward in time. And that requires both the view of risk and of potential reward, or, of point in time, and also trending and forward-looking information of operational strength and products and services. And that's what we sort of regard nominally as ESG 3.0. We believe that, especially today with how much things are changing, whether it's access to information, advancements in data and technology, or changes in consumer preferences and regulatory influences, to evaluate companies as potential investments, we need to consider a holistic set of inputs with ESG and impact considerations forming part of that information. And so at Radiant, our observation is that evaluating the prospect of real change means looking outside of the normal information angles to sort of think bigger picture as built from a very granular level. And part of the impetus for launching our own firm was to build a more robust approach to evaluating ESG and impact investment potential, which necessitates moving beyond a simple exclusions-based philosophy and away from a perspective that's anchored on ESG ratings to a more meaningful assessment of how a company's actions, products, and path of travel are both affected by and give rise to real economy effects. And I think I should just be clear, since there are so many different ways to think about ESG in the marketplace, that Radiant's motivation for evaluating company level ESG and impact characteristics in our process is driven by our desire to have as much material and actionable information in our stock picking process. So not an effort to express personal, political, or ideological views in our portfolio. So we incorporate these additional considerations as a means to understand the totality of the threats and opportunities companies face that may not naturally show up in financial statements and traditional metrics. So recognizing, like today, the near-term effects of short-term transitory market movements, we have been able to demonstrate that considering ESG and impact in a thoughtful investment approach can be accretive to alpha and risk reducing. I think it's important to say that as active managers, which is a distinguished group, we're operating in a hyper competitive landscape. We need every advantage we can muster when it comes to understanding the forward path of travel for companies. So, our method is intentionally next generation, forward thinking, and most importantly, results driven. So, summing it all up, I think somewhat ironically, in an ESG 3.0 world, we no longer distinguish ESG investing. It's just investing.
I love that. That's a really great point. Now, Radiant's flagship strategy was US small cap, as we mentioned earlier. How does ESG specifically help you in small cap investing?
Yeah, well, while Radiant's investment capability has grown to be global and span the cap spectrum, we did start with US small cap equities, primarily because we thought it was an opportunity to demonstrate our skill set, in particular when it comes to evaluating ESG and impact, which is more challenging, as you go down the cap spectrum, as well as having an opportunity to differentiate ourselves in, again, a highly competitive industry. The small cap space is really exciting because that's where innovation lives.
Mm-hmm.
But within this very story-driven part of the market, it's up to us to pick the winners. It's easy to be dazzled by the amazing technology at the heart of things like infusion medicine, wearable devices, green hydrogen, battery storage, semiconductors, even AI. What we're after is getting as much information as we can on companies to help us assess them in absolute terms as well as relative to their peers. It's important to remember, especially as it relates to small caps, that we're not investing in science, we're investing in companies, and that it's a subtle but important difference. So with small caps, we're typically dealing with younger companies that may be having their own growing pains, missing or estimate data, and asset class considerations. We want to understand which companies are setting themselves up to be relevant now and in the future. The challenge is that many small cap companies languish for a number of reasons, and we want to avoid companies and importantly stocks of companies that aren't going anywhere. So we look for fundamental strength and or improvement, and that spans everything from what do we see when it comes to sales and profitability? How can we bring companies that are not yet profitable into our sight line, knowing that some are going to be the winners of tomorrow? We're interested in companies that are achieving economic traction, and how's that being demonstrated, and how is a company achieving results, and is that sustainable? We also look at product mix, how that mix is set to meet future demand, and the array of products. Many companies we look at in the small cap space are specialists in one or two kinds of products as opposed to a diversified, range of stuff.
Mm-hmm.
So as an aside, I'll say that smaller companies often present us with a very pure way of achieving business line exposure and can play, therefore, a key role in sustainable investing generally. So they're exciting for their upside return potential, but equally for their ability to bring impact to public equity investing in a way that's very different than large cap stocks. There are things that are especially important among smaller companies, like the profile of the management team, how concentrated is ownership, is the company controlled by a narrow group or is ownership more diverse? everything I've talked about so far has benefited from our understanding of a company's point in time ESG characteristics, its trending ESG evolution, and its impact profile. And importantly, we view those three as distinct and different from one another. And so our research is really aimed at understanding whether a company is on a growth trajectory that will persist in a way that's sustainable over a longer period of time, and how the company is going to remain or become relevant. Then the investment question, of course, is how much are we willing to pay to participate in that company's forward success? ESG and impact form an important piece of the puzzle. I think, Radiant has built a pretty phenomenal system of integrating traditional fundamental information with new and technically orthogonal types of information to help us produce strong investment results in this very exciting and often somewhat opaque part of the equity market. We're often fond of saying that we invest at the intersection of strong ESG and strong fundamentals. That's actually an unnecessary division of concepts. We're investing in companies that we believe have the right pieces and internal chemistry to achieve success tomorrow. And so far, results have been strong. Our strategies have significantly outperformed in two very different market environments between 2022 and 2023. And importantly, that's also been over a period of time in which many people have written off ESG as being unnecessary or even a detractor of value. And we couldn't disagree more. When we look at our own results and decompose our returns into what could have been achieved with fundamental models only, we see that our results would have still been strong, but less so than with the full complement of additional information that ESG and impact bring to the table.
So I want to ask this question because I think there's a lot of misnomer on this, and is that with respect to ESG options for investors today, right? It seems that some investors immediately associate, it's ESG with passive investment. But I would love to get your thoughts on this after hearing, and noting your comments that you really have reflected active investment stance on this.
Right. No, it's a very good observation. It's definitely a shortcut made by some investors. While we certainly do see a fair few large funds indexed to an MSCI ESG benchmark, though I will argue that that's not exactly passive. The majority of institutional active managers are using ESG information a little or a lot in their investment practice. And so why is that? Because active management is extremely competitive, and we're all looking for that edge or that extra bit of information that will give us additional insight into how the company is doing now and how the company will fare in the future. So in the same way, you can find nominally passive value funds or growth funds. You can find nominally passive ESG funds. I will say they tend to be more prevalent in the larger cap end of the spectrum. But in all instances, you're just outsourcing your definition of value, growth, or ESG to an index provider. We see enormous benefit in doing the work ourselves in what we believe to be a more sophisticated way that includes multiple dimensions of sustainability. Frankly, that's the kind of hard work that needs to go into any active strategy. And I will add, perhaps controversially, that when we look at segments of the market, like the retail and wealth management segments, we think that investors have been largely underserved. We don't see as many great options for individual investors when it comes to ESG because of the dominance of index tracker solutions in that space. We can have a much longer discussion about how many of those are, again, actually not passive, even though they track an index. One, they aren't really designed to capture the opportunities that a process like ours is designed to uncover. And two, some are actually pretty expensive, which really defeats the purpose. And in most instances, what you're going to get is just a portfolio that's got a better ESG footprint, than a mainstream benchmark. And again, I would argue, I'm not sure what that really ultimately gets us.
Well, I have to ask you, because obviously with your background and expertise on the subject, what changes or updates do you see happening in the ESG space over the next 5 to 10 years?
Let me get out my crystal ball. I guess I'll start with what I hope is going to happen. After the election in the US, I hope that ESG will stop becoming a political target and go back to being the remit of the investment world. There are so many great investment debates we need to be having about these ideas. But the idea that the prudent thing to do as fiduciaries is limit the information we consider in evaluating companies as potential investments is frankly nonsensical. And for specific states to limit not only the range of investment firms that could be considered as bringing value-added solutions to a plan, but then also constrain that subset of managers from evaluating any and all considerations that they could find to be material to a company's long-term trajectory and to the portfolio overall is sure to lead to binary outcomes and likely not positive ones. To put it in perspective, one study estimated that Texas's anti-ESG legislation has cost state retirees $270 million.
Oh, wow.
And there was another one that warned of the potential for up to $6 billion in losses. And I mean, that's absurd and unnecessary. Frankly, the politicization of ESG is likely to lead to a bunch of lawsuits with retirees holding the bag. And for what? Do we need truth in labeling? Yes. Do we need additional analysis on the part of regulators when it comes to new types of information that we bring into our collective investment practice? Of course. Do we need oversight in the form of ERISA? Absolutely. But investment professionals and the market itself have a very effective mechanisms to sort out what works and what doesn't. And I guess echoing back to where we started this conversation, my longer run prediction is that we will completely abandon the ESG label. The label means so many different things to different people that it really no longer serves us. What we call ESG now is simply part of good investing. And while I think the label will go away, I'm confident that the underlying principles will endure as part of a thorough understanding of a company's competitiveness. So in an ironic way, this evolution, which we regard as positive, may be hastened by the current political drama. And it just makes me think of one of the recent quotes that we really love from James Quincy, the CEO of Coca-Cola, who said, if ESG becomes toxic as a phrase, which it basically has in the US, it doesn't matter to me. I'm just going to stop saying ESG. But the idea that for my basic product, I want to be water positive, I want to have a circular economy on my packaging, and I want to grow our business with less sugar. You can call it anything you like, but no one with common sense says those are bad ideas. And that really sums it up, because the point is that when we're able to move away from opaque labels like ESG and boil it down to something more concrete and tangible, then it's hard to dispute.
Well, Heidi, I could probably talk with you for hours on end on this topic. And as you said, we are coming up with elections, so many things, coming up. And I would really love to dedicate more than what we have to talk about this with you. Thank you so much for the information you shared. I think our listeners are going to have a wonderful time hearing everything you have to share today. Thank you so much. All right. Well, Heidi, I'll see you soon.
Thank you for listening to this month's episode of the CFA Society San Francisco podcast. We hope you enjoyed the engaging discussion. Join us next month for another new episode. This podcast is produced by CFA Society San Francisco, a not-for-profit professional association providing professional learning and career resources to over 13,000 investment industry professionals worldwide. To learn more about CFA Society San Francisco, visit our website at cfa-sf.org or connect with us on LinkedIn.